And Alice had asked, I have questions when to close the trade. I learned we should close our trade at a 50% gain because we don't want to worry about what the underlying will do next will be assigned. Is that correct? I was trying to wait till it expired by itself to get 100%. She was watching a different YouTube video, different YouTube instructor. He says the teacher was showing us his vertical credit spread and said that they should be closed at 50%. She says, my plan is to keep all the above stock. If I'm in X, for example, I'll do a covered call. So I'm going to just leave it there until I get assigned and keep the 100%. Okay, my initial response to Alice is we're kind of comparing apples to oranges. Most covered call or naked put sellers, what we just sort of reviewed with Pierre a little bit, will look for the max return. Getting assigned on the covered call, that's the goal of the in-the-money covered call picks of the day, Pierre, we just discussed. We want to be assigned to earn that return, or having the naked or cash secured put expire worthless. Now, a common approach used by investors, of course, is the 80% rule. If I sold a covered call for $1 premium, and I was looking to make a 3% return if I was assigned, and the stock moves up, and 5 days, 8 days before expiration, I can liquidate the position that's now deeper in the money for 2.8% of the 3% return I was expecting, I might take that off the table early, absolutely. Or if we sold the naked put for $1, the stock moves up, we can buy it back for 20 cents or 15 cents. We might just close it early rather than give the chance that the next 8, 7 days, the stock could reverse against us and we may have to buy it back or a black swan event can come up. Now, most OTM, high probability credit spreads, like the ones we just showed for the Bull Put Weekly, we look for the positions to expire and we do not close early. But if your spread approach is using an at-the-money debit spread or an out-of-the-money debit spread with closer to a 1-to-1 risk-reward ratio, that is a different approach. Many investors will look to close those positions if they got a 50% profit on that out-of-the-money debit spread prior to expiration. But we're comparing 3 distinctly different approaches to trading, and a rule that applies to one strategy does not necessarily apply to all other strategies as a management. Again, let's go back to what we just talked about in our first presentation there for Pierre. We showed the bull put credit spread numbers over 2020. Average of a 19.5% return. Average on the losers was 39.5%. It was an 89% win ratio. If I did that over 100 trades, and again, following the same sort of guidelines we were talking about, if I took the $15,000, and allocated 33% or a third of that into each of the top 3 bull put credit spread trades that came up, we see a very high potential outcome. A little bit exaggerated, that's over 100 trades. We saw 70 trades or so in the 1-year performance that we looked at in this case. So that's highly exaggerated. And again, as I mentioned, numbers are a little bit different. You can play around with this tool if you go to radioactivetrading.com, click on the resources tab. This is called the trade simulator tool. You can run your numbers there for the trade simulator for what kind of returns you're seeing and what expectations you might have. Okay. Up at the top, I do need to reiterate this. This program's purpose is not to predict or project that you will earn over the next 100 trades, but it's going to give you a demonstration of the effect of money management as it relates to trading. And that's what I'm showing us here as well. Now, let's close these high probability credit spreads, deep out of the money, 85% probability or higher at a 50% gain. In other words, I'm going to look to close positions when I hit 9.8% return rather than the average of 19.5. We're going to keep the same loss amount and the same win ratio, and we see almost 1/10, a little bit less than a tenth of what the original projection was, with 89 wins and 11 losses. Okay, that is a big change in return. It's huge. It's not to say it wasn't successful, but it's a huge change in return. And I hear some gurus say this, but when they say this, they're not talking about 1 week out, 2 week out, deep out of the money credit spreads. Because their idea is when they say it, okay, so if you close your spreads early, what you're going to be able to do is, yeah, you're going to lower your return, but at the same time, this is going to go to almost zero. You're going to have a 95, 96% success rate. Our testing has shown that that is not true. Those that go against you still go against you for the average of the 49, 39, 50% loss. They never hit the 50% target where would have gotten out. Because either they fall against you right away or they start falling against you slower than the first few days of the trade. They never hit that 50% profit with the out-of-the-money credit spreads in these cases. It's very difficult to see that unless the stock suddenly jumps up 10%. And if you closed it out and then it suddenly fell 30%, where you would be at a loss if you stayed in it. That doesn't normally happen at all. So this is why we don't close it early, because every test that I've run, the loss ratio stays the same. You don't increase your winners by closing it out early. We're already at 86, 87, 89% success rate. That's very hard to improve upon in those cases. Okay, so all you're doing is lowering your return. But a more accurate depiction, and this relates to what Stephen had mentioned in our previous conversation there we were having for Pierre. He says, were you surprised by the results? The average I typically see, again, for the bull put credit spreads is an average return of around 15%, losses on the losers of around 49%, and about an 85, 86% success rate on those positions. Now, just using the simulator numbers, this looks kind of similar to what we were talking about after maybe 100 trades, of course. We could potentially increase this up to a high level of $61,000. The low level is only down to about $9,000. That's significant, though, isn't it? That's about a 33% decrease on the starting value of $15,000. We lost about $6,000. That will happen with the leveraged spread positions. It's the nature of spread trading. But now I say to myself, to be safe, I'm going to close my winning positions instead of at a 15% return, holding them to expiration and having them expire. I'm going to close them at 7.5%. But my testing has shown the loss limit stays the same. These losers never hit that 50% gain. Maybe one does, maybe 2 out of 100 would, but they don't hit that profit level beforehand. You still keep the same loss area, and now same win ratio, 85 winners, 15 losers, you end up at a loss. You've given up close to $7,000, down almost 50%, by closing the positions early. Weekly out of the money naked puts, weekly out of the money credit spreads, where you're only getting 10, 15, 20, maybe 30 cents of premium to begin with. Yes, you want to get those to as close to 100% profit as possible, or the 80 or 85% want to close early. Don't want to close these early at 50%, because then you're completely throwing off the results you're expecting from your trading plan. That being said, the Options Educator, I don't think, was wrong at all. He was likely looking at a different structure that Alice was viewing, but she didn't quite understand that he was maybe using a call vertical spread or a put vertical spread, but it was most likely at or out of the money. What do I mean by that? If I'm doing a bull put credit spread where I know I can be assigned on the short put strike price, using the approach that we talked about before, I'm looking for deep out of the money positions with still a good reasonable return. Here on Tesla, right before the webinar, I could sell a June 11th, 14 days out in time, 560 put, and buy a 555, and get a net credit of about 50 cents. This was about an 88% probability above, I think, when I checked it at 358, if I'm not mistaken. So my true risk is only 450 on the 5-point spread. We've taken a 50-cent net credit for 11.1% return. As long as the stock stays above 560, I don't have to be worried about buying shares of stock at the short put strike price. On the right, we have a further out in time, July 16th bull call debit spread, where we're selling the 625 call and buying the 620. Now, these are expensive, 4,600 versus 4,852. But the total net debit on this 5-point bull call debit spread is only $252 for the chance to make $248 if Tesla stays above 625, about a 50% probability in the next 49 days. But if it stays above that price, what happens? Well, our broker essentially could buy shares of stock first at 620, sell them at the short call strike price like a covered call at 625. We'd make 248 on an initial debit of 252. It's close to a 1-to-1 risk-reward ratio as you can get. Now, you can get higher if you do further out of the money, but it's about 100% return. Most investors who follow this approach with the out-of-the-money debit spreads, with this 1-to-1 risk-reward ratio, if the stock goes up to 630, 635 more likely, or 640 in the next 10 to 15 days, they might be able to close this whole spread and not make the full 5 points back. That won't happen until expiration when all time value is gone, but they might be able to take in a profit of 120, 125, meaning that they're essentially closing out the spread with some time value remaining on both options of roughly about $370. They're selling to close the 620, buying to close the 625, getting 370, not the full 5. They paid 252, so they're making 120, 125, or close to 50% of the maximum profit they expected to make. And they're doing that 30 days before expiration, 20 days before expiration, something along those lines. This is the approach, or maybe even a diagonal calendar spread, where I might close the position early for a 50% profit. You do that on a short-term, weekly, 2-week out credit spread that's deep out of the money, where you're looking for an 11% return, you're going to adjust your trading plan to see the effect where it might not be giving you the profits you're expecting or may actually result in a loss, and you're not likely increasing your win-loss ratio in that case. Okay, so that's the comparison there in relation to Alice's question. We were comparing apples to oranges. For her covered call positions, she had followed up and said, covered call or having a naked or cash secured put expire. You had said that the common approach is the 80% rule. Why not wait till 100% profit in those situations? If the stock is up, it will expire by itself. And this is a judgment call. If on May 1st, I entered a 38-day out covered call, these aren't actual prices. Allies is something I have a married put in. So, I just grabbed some numbers. But if I bought 100 shares of Ally at 50.25 back on May 1st, 30 days ago, and I sold the June 50 call, which was 50 days out at the time, for 210, well, I have an at the money at the time covered call where I'm looking to make a return of about 3.8% if I'm assigned at expiration, still 21 days away in this case. But now that the stock's up at 54.71, hit 55 today at one point, I believe, I probably could liquidate this and make 3.5% return of the 3.8 I expected. I'm at about a 90% of what I expected to make. I could buy to close the call, sell to close the stock at the current market prices, and I've made 90% of what I expected to make 21 days early on this position. Why close it out now instead of waiting for that extra 0.3, 0.4% of time value to decay on the position? Because a lot can happen in 21 days. That doesn't mean that if I take the profits here and move into a new position, I might not lose on the new position. But I can get 90%, 85% of what I expected to make on this trade 21 days before expiration. So that's a common approach to close the position early. But if I want to leave it alone for 21 days, I still think the stock's going to stay above 50. Even if it pulls back another $3, $4, I'm still getting assigned, making the max 3.8% return. That's a perfectly logical approach too. Both approaches are fine. But when I see these kind of numbers, and again, they're fake, I just put them in for the example for Alice. 21 days left to expiration. I can get out with a 3.5% return if I liquidate. I might as well just take it off the table. Or if I don't need the money for anything, I'm not considering a new position, there's not a new position I've seen come up that makes me feel more comfortable allocating the $5,000 or $10,000 I have in Ally right now, okay, I'll just leave it alone. Let it go and make that extra 0.3% in my favor. But another way to look at it is you have a trading plan in mind when you're doing your covered calls. We already talked the first series webinar, the webinar that is going to be posted before this one. They're probably going to be split up. But remember, Pierre was talking about 1% time value with an out-of-the-money premium. Okay, that's perfectly fine. That's an approach that he's using. So that means that for monthly, every 20 to 30 days, he's looking for a 1% premium. Right now, if I could liquidate this position for a 3.5% return, holding it for the next 21 days of time, best case scenario is I only get another 0.3% increase of time value decay in my favor and getting assigned for the maximum profit. 0.3%, if I look at it not as a whole trade, but look at it as if I would open this position new, is it worth it to sit for 21 days to get 0.3% when I'm usually targeting 1.5%? No, I might take this off the table and look for a new covered call for June that does give me that 1.5–2% return of the time value so I can continue to meet my goals on a consistent basis. Again, that comes down to your trading plan, your risk tolerance as well. Now we're going to navigate quickly back over to PowerOptions real quick. All right, so now I've got the question pods up. I'm just going to navigate very quickly to the portfolio. And this is where we track our open positions and can evaluate rollout opportunities. Here's my ally position. Okay, it closed right around where it was when I was doing this at 3:48 p.m., I think. Here's that fake position. 5-1, bought ally at 50.25. Sold the June 50 call for, let's say, 210. 3.5% return, I'm sorry, 3.8% return max for about a 50-day trade at the time. We've gone through about 28 days already, 21 days more to June expiration. So 29, oh, there it is, 27 days we've been in the trade. So it's a 48-day trade, 3.5%, pretty good expected return. I'm sorry, 3.8%, but we're at 3.5 right now. I'm at roughly 90% of what I expected to make on the position. I have this alert triggered here in green. And what that's telling me, of course, is that, let's just take a look here. I'd set an alert to be notified if my time value is less than 1%. Okay, right now it's at 0.5%. So this means that if I hold it for 21 more days, even if I get assigned, I'm only making 0.5% time value profit for those 21 days. Maybe, oops, sorry, folks. Maybe it's better just to close the position now or evaluate a rollout opportunity to increase the premium, which comes with a price. There's time value left in price. We're at 3.5% liquidation value, or 91.1% of what we expected to make on the total trade. And I do have some rollout opportunities. We could roll up to the June 55 call. This would be done at a debit, but I'd increase my return from 3.8 to 6.4. If I roll out to July, I sort of keep a positive credit, but we only go up from 3.8% in 21 days to 5.4%, an additional 1.6% return for an additional 28 days to 49 days total remaining from today. Does that match my trading plan? But the rollout opportunities are powerful because it shows you right here what your new return would be, the new probability of assigned. Does it make sense to liquidate right now, or wait 21 days for just a 0.3% return, or to roll it to look for a potentially higher percent return if you're confident that you might still be assigned at those prices? This, I'll be honest, going up to the June 55 call is a little bit risky because I'm taking off the downside protection because I'm going to have to roll for a debit. I have to buy it back at 488. And then the June 55 is only at 131, so we're down essentially a debit of 147. But if I get assigned at 55, that could be a 6.4% return, but the stock falls back down to 52. I might be losing money on the position where I could still be assigned for 3.8% here if the stock's still at 52, or I could just get out now, make 91% of what I expected to make, and not worry what Ally does over the next 21 days.